In terms of our due diligence process as described on this slide, we very much focus on what we call the 4 Ps. So that's people, process, pedigree, and performance. And to be fair, I don't really need to run through on the slide what each of those different areas means. I'm more than happy for you to take a look at that as I talk or when you see the recording over the next couple of days. I wanted to, on this slide, talk more about the 3 key areas that we focus on very strongly when we do our due diligence. And those 3 key areas tend to be, or not tend to be, are credit, legals, and experience, or as we like to refer to them as battle scars, which is always funny. So firstly, when we look at a prospective investment, we look at its credit process, and really that is very much a key factor, and it's the first building block of our review. The reality is, if you can't assess credit quality of a borrower correctly, then you really should not be running a lending business. So really important. But in all fairness, it's really the first stage of what we go through. And more importantly than looking at that credit process in our due diligence, we look at the legal side of the business. And what do I mean when I say legal side? So we want to look at the team that works there, and we want to look at the legal documentation that they operate, and we want to understand that they have a very strong legal ability and that their legal documentation is clear and concise and gives them a strong ability if something goes wrong, because let's not kid, things always have a funny habit of going wrong. So we want to make sure that if something goes wrong, they have a very strong ability to step on the underlying collateral that is being used to secure the loan and take control of it. This collateral could be property, could be other real assets, or even contractual cash flows. But at the end of the day, we want to satisfy ourselves that the lender's legal documentation and their team's ability is strong enough to protect them in the situation of a failure. And then the third level that we step up, which is again more important than the legal side, and probably a little bit more of an art in terms of this due diligence process than most of the other items, is we want to understand the lender and their team and their ability to deal with tough situations. So there's no point in having the best credit system, and there's no point in having the best legal documentation in the world if your team just does not have the capability to deal with a default situation. And let's not kid, I'm not sure if you've been through those types of situations yourselves, but not everyone is made up to deal with a difficult situation or event of a default. And we always say that from our perspective, our managers need to be highly experienced, and we like it when they've been through bad experiences. In fact, we like it so much that quite often, if we find that the team hasn't been through a debt default cycle or hasn't experienced bad debts in the teams that they've worked in historically, then we typically will actually pass up on investing with them. We like them to be able to demonstrate the transactions that they've found difficult. They need to be able to talk us through what they've learned through those situations. And we need to understand the actions that they took to protect their loans, because ultimately we're going to be the parties that are funding their loans, and we want to make sure they can protect us. So in short, we want to see their battle scars. So with all three of those 3 things in place, we get comfort to proceed with funding a loan book. On an ongoing basis through the due diligence process, we look to build deep relationships with the various loan platforms and lending managers that we invest into. And importantly, we maintain a regular program of review around their operations.